This might be a dumb question, but how do you tell the difference between accumulation to go higher and distribution to go lower? Very good question. Pattern of the price action and volume spikes. Where the price action occurs. So, do we have any lower lows is question number one. So let's take a look at my little segment tool here. What are these pivots? Every time I see a pivot, let's put a line, starting with the bottom. Do we have any lower lows? No. I'll answer for you. The answer is no. We have no lower lows. So that's indication number one, that this is not distribution. Number two, do we have any major high volume spikes? We have one moderate volume spike there. So then, once I see the volume spike, my eyes go to the price action. What was the result of that volume spike? Aggressively green candle that never even tried to top tick to fill back down. If I see a candle like this that's very green, especially going into a prior high with volume, and then the next follow-up candle is an engulfing red, that is a liquidity sweep, which mostly means distribution for lower prices. So we didn't get an engulfing red candle that engulfed the prior green. Even though we had a high volume spike, we had an engulfing green followed by a very, very minor red on the 1 minute chart that kept on going higher. So that to me is absorption for higher prices. We have this little group before that never put in a lower low and put in what we call an ascending triangle, which is a bullish pattern. An ascending triangle is price action that has a flat top with a increasing bottom. That is an ascending triangle, not a bullish wedge that some people think. A bullish wedge looks like this, which is buyer exhaustion. And the premise is the buyers keep on buying until finally they get tighter, they exhaust, and then we break lower. An ascending triangle, not an ascending wedge, is a bullish pattern which shows absorption. Buyers buy, sellers hit, buyers buy, sellers hit, and then the sellers start to weaken, and then we absorb all the supply that's sitting here, and then blip, we rock it. So that's the patternized price action part of things. So we have no lower lows, we have no engulfing liquidity sweeps, we have no high volume top ticks. We're grinding into a prior high with no rejection, and now this candle breaks above the prior supply right here. Then once we break above the prior supply right there, now we stick to it. We use it as an SR flip, support resistance flip, SR flip. Prior support, now new resistance, or I'm sorry, prior resistance, now new support. Bottom wick, bottom wick, bottom wick, bottom wick off of it, all with low volume spikes to absorb the supply that's sitting right here. Because in my mind, we have a supply sitting right there, an order block supply that we need to absorb, and which we've done, and we broke above and go higher. So as long as the market is putting in higher highs with no high volume top wicks or engulfing liquidity sweeps, this is absorption. They're absorbing prices to go higher. The more volatile the price action, the least likely it's absorption. The more volatility on the red side, the more likely it's distribution for sell-off back down. But if it's just, that's why they say don't short a dull market, because dull markets typically have absorption to the upside. And that's what we've done. We've absorbed into prior supply. There's no high volume top ticks to indicate any kind of sell order sitting at this area. And now we've absorbed to go higher. And the first time I see one or two things. Number one, a high volume spike down in this area. Number two, large green to brace higher, and then immediate top tick red candle to engulf the green. And then that's when we'll come back down. If I don't see either one of those two things, then I'm not shorting anything. And I'm certainly not closing out any long positions.